The top 15 principles of money most people get wrong. So I'm showing this video because, are your finances where you want them to be? If not, there's a very good chance that one of these 15 or maybe several of them are the underlying root cause. So I've seen the finances of thousands of people, and these are kind of the things that I find people most commonly get wrong that have major effect on their life. So here they are. I'm going to go through them. Now, these are all things I've talked about before and in more details on other videos. So if you see them or other podcasts, if you see one, go to my blog or podcast or video, you can find more detail on them. So I won't cover them in great depth today, but I want to kind of show what these issues are, and maybe you can see an issue that, that's something that helps you. So here's what they are. So here's the principles. These are the principles that work, but many people get them wrong. Number one, everybody needs a financial plan. A financial plan is your life plan. Understand your values, what's important about money to you. Risk tolerance is a learned skill. It's the ability to do nothing when your investments are down. Stocks are more reliable than bonds or fixed income long term. I think a lot of people would be surprised about that, but maybe not if you've been watching my videos. Dividend investors usually pay more tax. I think most dividend investors will be surprised by that, but I've seen the tax returns of so many dividend investors and other investors, and they usually pay more tax. Self-made dividends beat ordinary dividends in every way. I'll talk about that a bit more, what they are. Investing in your own country is safer. Focus on maximum reliable or long-term return, not reasonable returns with less risk. Nobody can retire comfortably with a balanced portfolio. You need investment growth after you retire to retire comfortably. Real estate needs a large mortgage to be a good investment. Borrowing to invest is the secret to building major wealth. The big risk to your retirement is inflation, not a stock market crash. A growth mindset is how you make smart decisions, not a fear-based mindset. And optimism is realism. It's a good topic of mine. So, all right, so let's talk about these a little bit. So first of all, a financial plan is really a life plan. So I talk to people sometimes that are quite well off, and wealthy people sometimes think, I've got more money than I ever need. I'm never going to spend all of this. So I don't really need a plan. I'll just live fine and just do estate planning. But it's not actually true, because it's a matter of, it's your life plan. What do you want to do with all this money? So your existing lifestyle, you're not going to get anywhere close to spending the money that you have. So what do you actually want to do with all your money? So that means you could live quite a bit more. And in a financial plan, we have to figure that out. So you know what? You could spend $50,000 or $100,000 a year more than you're spending. So think about this. Maybe you want to make a major change in your life. What you could do a lot of, have a lot of fun or do a lot of very interesting things with that kind of money. Or maybe you want to give it to kids or give it to charity and think what's the most effective way. But it's kind of thinking through what you want to do with your life and with your money. That's what a financial plan is. So everybody needs it, even people with tons of money. Now, some people live paycheck to paycheck, think they can't do anything, they're kind of locked in. So they can't have a plan, they can't afford a plan, they can't change anything, they're just stuck. But you know what? If you're in that position, often what it is you need to set priorities. I think you've got a whole bunch of things in your fixed budget that you think you can't get out of, but maybe you can, and make some radical decisions to get rid of some things that you aren't priority to you, so that you have the money for things that are. And that's what a financial plan can help you figure out. It's your life plan. Now, in case you don't know what a financial plan is, just give you a simple example. So a financial plan might, after looking through your life, what you're trying to do, it may end up with something like this. This is a really short version, but your plan is to be able to retire at age 60 with $100,000 per year before tax. In today's dollars, you need to accumulate 4.7 million. So that's an example of a plan that we did for somebody. At age 30 now, I have 100,000 investments now. So to achieve this goal, but basically the plan is invest $1,500 a month to your RSPs, get a refund on it, invest $1,000 per month to your TFSAs, invest your tax refunds annually, invest for a long-term growth of 8% per year before retirement and 7% per year after that. And that's how you achieve the goal. And now you have you do those things now, then you get the future that you wanted, that you figured out. So there's 5 key parts to a plan. It's when you want to be able to retire, even if you don't choose to at the time. What's the lifestyle in detail that you want to have then? what's the magic number? How much do you need to have? Like in this case, 4.7 million. How much do you need to have to be able to be financially independent or to retire? What are the steps? What do you have to do between now and then? And what's the return that you need to get? So that's what a kind of plan is. And it's important that it be something that you're confident, something custom that you decide exactly. Otherwise, that's the way you'll probably do it. I see a lot of financial planners, they'll just say, oh, to retire, you need 70% or 75% of what you're making now. And that might be true, but it might not be. And the thing is, if it's just a generic number like that, you're probably not going to follow it. It's much better to do something in detail. Let's look at where are you going to live when you retire? What are you going to drive? What entertainment do you want to do? Like, how are you going to spend your time? Let's work out the actual cost of the lifestyle that you want, and then make sure that when you're ready to stop working, be financially independent, you are able to do that. And we have actually really flexible software. So when we do a financial plan for people, we're actually able to go through many possible life scenarios for them very quickly. Because they'll say, what would it take? I'd like to take, an extra trip a year, either have another 5 or an extra 10,000 a year for travel. What would I have to do that? Or I'd like to be able to retire. What if I want to retire a couple of years earlier? What I have to do that. And when you see the actual numbers, if I put in $500 more than now per month, then I get, an extra 10,000 a year to travel for the rest of my life after I retire. So is that worth it for me? And when you have real life trade-offs and the numbers work, are figured out like that, you can decide what's important to you. So this is all, I was trying to show you how a financial plan is really a life plan. Everybody needs it. Number 2, understand your values. What's important about money to you is a question we ask every client, and we're trying to understand what your value, what really is important to you. And it's because the financial plan has to speak to what you're really trying to accumulate. And so if you haven't thought this through, then, if you're struggling with money, it's maybe because you haven't decided what's actually important for you in your life. So that's kind of what we're helping you to do here. And once you do that, it's clearer what your goals are, which goals are priority for you, and how you're really trying to what you're really trying to do. Now, so common ones that we get, there's a long list of different values that people have, but the most common ones are, security, having peace of mind, just not worrying about money, freedom, so that's time freedom and financial freedom, and just basically, a free life. Some people just want fun and happiness. Some want, money actually means self-confidence to them. Just to have money is self-confidence. That's actually the thing for me. It gives me a feeling of self-confidence that I have it. It's hard to explain, but that's kind of what's behind the motivation to have it. And a lot of people, like in this FIRE community, it's independence, financial independence, or it's knowing that you're not reliant on anybody, on family or anybody. You're able to make it your own way. So that could be an important value. You want to be able to feel independent or something. And that's what you're doing with your money for. When you understand that it helps you be motivated and, figure out what's priority for your life and actually achieve it. Number 3, risk tolerance is a learned skill. Now, risk tolerance is actually a big problem. And it's a much bigger problem than people realize, because, you go to most advisors at a bank, and one of the first things they do is you're filling out this risk tolerance questionnaire. And usually it's a disaster because it says that you're moderate risk or something, and they put you in a balanced fund. And then already you basically can't achieve your goal. It's just too low a return. They haven't taken the time to explain or help you learn to have a higher risk tolerance. And that's a massive difference for the future that you want to have. Now, the ability to do nothing when investments are down, it's kind of an interesting thing, because it's like a lot of people think that it's volatility. So in fact, that's the common belief. In the investment industry, they measure risk tolerance based on volatility. So, or investment risk, how much your investment goes up or down. But really, it's your risk tolerance. And it's, once you fill out the questionnaire, that's not who you are permanently for your life. That's how you answer the question at that point in time. Really, risk tolerance is this ability to do nothing when your investments go down. It's not volatility. And I'll give you an example. So I forget sometimes people, here's a theoretical example. Let's say that you are just somebody that could not tolerate any fluctuation in investments at all. You just need super safe, can't tolerate anything. Okay. However, you're going out to some faraway island or going to the moon for 30 years, and you're not even going to have access to the news or your investments, and they're just going to sit there for 30 years. To me, that actually is high risk tolerance. Why? Because you're going to do nothing when the investments are gone. If the investments go down, After 30 years, they're almost definitely going to be way up. So that is actually, you've actually got fairly high risk tolerance if you're not going to look at it at ever. I have some clients that actually say that, I never look at my investments. So if they were down, I would be unaware. I would just keep sticking with it. And that's a form of higher risk tolerance. On the other hand, I find some, especially some guys are really cocky that say, well, I'm never going to lose money because they do really active trading. So as soon as it starts to go down, they sell something. I'm never going to lose money. And I'm going to try, I can buy through skill of active trading and I'm not going to lose money. That to me that is actually a low risk tolerance, which means is you can't tolerate a decline. You're going to go through all kinds of methods to try to avoid a decline. Well, then you actually have a kind of a low risk tolerance. So maybe you shouldn't do anything risky. So there's a different way. I think it's a more insightful way to see risk tolerance. Okay, so number 4, stocks are more reliable than bonds or fixed income over the long term. That's actually a really important thing. So I've shown this graph a lot of times, but this is standard deviation, which is really a measure of uncertainty of returns, so the variability of returns that you could get. And these are after inflation. So this is stocks versus bonds versus cash. And so it's a picture of risk. So stocks are more volatile than bonds over 1 year, 2 year, even 5 year. But when you get to 10 years, not much difference. And when you get to 20 years or more, stocks are actually more predictable than bonds or cash. So you can more accurately know where the stock market will be after inflation 20 years from now or 30 years from now than bonds or other fixed income or T-bills as cash. So they're actually quite reliable. And so I'll just show you this on a long-term chart. So this is a 200-year chart. And if you see this, I've shown this chart before, but if you see, this is the long-term return after inflation of stocks. $1 went to 1.6 million. It's basically been 6.8 real, meaning after inflation. So the long-term return of stocks is roughly 7% above inflation. And see, in all environments, it's been always pretty close to that line. Bonds, they have these periods. They had, where interest rates were rising and this high inflation. So bonds kind of went down, down, down for 40 years after inflation. So from 1940 to 80, you basically lost half your value, half your purchasing power if you invested in bonds. And yet from 1980 till now, during COVID, interest rates basically came down every year from 20% down to 1%. So that makes bonds look really good. So this was a very unusually high period for bonds. This was a low period, but see how much less consistent they are than stocks. So people tend to think stocks, it's up and it's down. This is what 1 year periods look like for the stock market. Lots of gains. 3/4 of the years are gains, and there's a fair number of big ones, but there's a reasonable number of losses. So it's kind of unpredictable. But see, when you're in for 25 years, this is what it looks like. It's always been a good solid return. Some of them are 5% way back in the early 1900s. But here in the modern stock market, the worst 25-year period has been about 8% a year. So it's been, you see this, it's good solid returns once you're in for a long period of time with the stock market. Number 5, dividend investors pay more tax. Now, if you look on the blog world, the two main types of investments that people talk about are index investing and dividend investing. Both of them have their pros and cons. But one of the things about dividend investors is they always think they pay less tax. But in most cases, they actually pay more tax. And I've seen tax returns for dividend investors and other investors, and they usually actually pay more. And you look at tax rates, they see low tax rates and they go, that's why it's low. But it doesn't actually work out that way. And the reason is, so dividends are taxed every year. Even if you don't need the cash flow, you get a dividend and you reinvest it, and it's taxed every single year. Now, capital gains, depending on what your income level, they may have higher or lower tax rates. However, capital gains can be, 10, 20 years down the road. Like you buy an investment and you hold it for 10 or 20 years, you hold it for quite a few years. You only pay the capital gain much later when you take it out. That's why capital gains tend to be much, people that invest for long-term growth and don't think about dividends tend to pay less tax than people who are, trying to find dividend stocks and ending up with higher dividends. Now, so I've actually got some talks on this before. So deferred capital gains are the lowest tax type of investment income, not dividend investing. Another part of it is just how the taxable income is, and this does have some other effects. So, $10,000 dividend, there's a gross up in the formula. So it shows us $13,800 of taxable income, while a 10,000 capital gain shows us 5,000 capital gain, which means you get pushed into the higher tax brackets more quickly. There's government programs that are clawed back based on income. You get them clawed back more. That's another big factor in it all. So this is just roughly what tax brackets are. And see, these are dividends, Canadian dividends. Now, global dividends are actually taxed the same as interest, fully taxed. But Canadian dividends is here. You see some lower rates, for lower income people, but it's actually higher than capital gains for higher income people. But capital gains, remember, it's not just the capital gain. It's, for one, it's paid many years in the future. And for two, usually when you take cash out of investments, so you have an investment, you let it grow for a lot of years, and then you sell a little bit of it to take in whatever money that you need or income that you need. When you sell something, part of that is the principal you paid, and part is the gain. So I call that self-made dividends. Self-made dividends is, instead of buying companies that pay you a dividend, you just sell a bit of your investment each month or whenever you need the cash, and you have some capital gain on that investment. But generally, it's because it's partly your money and partly the gain, and because it's been years down the road, you're paying a much lower tax on it, and usually lower than it would be with dividends. Now, a related topic here is the self-made dividends. Let's talk about this a bit more. And I've done other talks on this. So self-made dividends beat ordinary dividends in every way. And it's quite shocking, this whole difference. So just to be clear what they are, self-made dividends is basically invest long-term for growth. You're going to have some dividend stocks, however you invest, because most stocks pay dividends, but you're not out looking for dividends. You're just looking for the best stocks with the long-term, most reliable, highest growth or total return. So then what you do is, when you need money, you just sell a bit each month. So, while you're saving up for retirement, you probably sell nothing. You just let it grow. And then when you retire or whenever you need money, you just sell a bit of the investments to get the cash flow that you want, and which means you're paying some cap on that amount. So I'll give you an example. Let's say you invested 100,000, it grows to 200,000 over time. Now you need 10,000 cash. Okay, so here's what happens. You sell 10,000, but half of that money here was your money and half was the growth. So 5,000 is a capital gain. And out of this 10,000 you took out, 5,000 is what you invested. 5,000 is the capital gain. Now, so that 2,500 is the taxable income, because it's only 50% of the capital gain that's taxable income. If you're at a 40% bracket, so this is a fairly high tax bracket, you're a 40% bracket, you pay $1,000 tax on 10,000 of cash. Okay, so that's where you are. And then if you go back here, so that would be this, bracket here, you're in the 40% bracket. Dividends, you pay 25% tax. This is only 10. And remember, this is money that you invested years ago. It's not that you got the dividend the same year you invested. This could be 10, 20 years later. Now, for self-made dividends, a lot of times it's for retirees that you get into it. And this is a way of getting retirement income out of your investments. And, it doesn't matter what your taxable income is, they're always taxed at a pretty low rate. Okay, while dividends, they get a high and low. There's certain rates where they're fairly low, but it's only certain areas you got to be really careful. And actually, they say the first dollar of a lot of dividend investors think that the first dollar that they get, they pay no tax on. But, first of all, it doesn't apply if you're under 65. It doesn't apply if you're married. It doesn't apply in a bunch of cases. But after you're retired, it doesn't apply at all, because if you have no other income, you get guaranteed income supplement from the government, which is clawed back at 50% for any income. So it actually has a 69% clawback on Canadian dividends if you get them. So here with self-made dividends, it's always a low tax rate. With Canadian dividends, you have something that's really high and sometimes high, and some occasions you got to be really careful with it all. But overall, you're paying much lower tax here. Now, just a head-to-head comparison, self-made dividends versus ordinary dividends. Okay, so with self-made dividends, all you're doing is selling the investment, whatever amount you want, right? So, which means you decide on the exact amount you want. With regular dividends, it's whatever the company pays. You can start and stop and change the dividend anytime you want. You're not forced to pay tax on dividends you don't need. So I see a lot of dividend investors, I can actually get a laugh out of this, because a lot of them dividend blogs, they're just posting, I'm up to 3,000 a month of dividend, up to 4,000 a month. But these are people that are saving for retirement, which is 20 years from now or something. So they're paying tax on all these dividends every month. They're paying tax, but they don't need the cash flow. So it's crazy how much more tax they're paying now when they don't even need the money. So you can invest property based on risk return instead of chasing yield. So if what their investors always kind of look at, oh, this one pays a 3, this pays a 4% dividend, and they're choosing their investments because of the dividend that they pay, not because they're a good investment. You can avoid buying expensive investments to get a higher dividend. If because you're just selling self-paid dividend, you're just selling investments. So you can invest in anything, and you can diversify globally. While with ordinary dividends, you have to invest 100% in Canada to get the low tax rate. For seniors, the clawback of government benefits from ordinary dividends is 5 to 6 higher than on self-made dividends. You pay less tax than on ordinary dividends, or sometimes no tax. The lowest tax type of investment income is deferred capital gains, and it gives you cash flow, not income. So by just selling investments, you're getting the cash flow that you want, but much of it doesn't count as taxable income. So income is, taxable cash flow. All dividends are taxable cash flow, their income. But when you're doing self-made dividends, you're selling a bit of investment, some of it's income and some of it's not. So self-made dividends, fix all the problems. So you pay tax only on the income that you need. You control the amount that you get. You get the exact amount that you want, not not the amount the companies pay you as dividend. You control the timing of the dividends. You can make it every month. Taxable income is not grossed up. It's only 50% of the capital gain. All right. So, and it's a very low clawbacks on government benefits. So, self-made dividends generally is about a 12% clawback on the guaranteed income supplement for seniors, but it's 69% on ordinary dividends. Diversification is unlimited. You can buy anything. If you're just investing for long-term growth, self-made dividends, you can have any investment you want, but you don't have to buy only Canadian dividend stocks. You can invest globally, no home country bias. You choose stocks based on the fundamentals like risk and return and growth potential, and not because of the dividends. And you can buy whatever you want for higher dividends. So I did a little scoring here, out of all these factors. I compared self-made dividends to, ordinary dividends. And it's basically the score is 10 to 0, right? So with self-made dividends, you pay lower tax, you have superior returns because you don't have to be in Canada. You can buy whatever you want, and you're not buying only dividend stocks. You decide the amount, you decide exactly when to get it, you control it all. You can stop, start, and change it anytime you want. You're taxed only when you need the cash flow, not when you don't need it. You can diversify globally. You don't have clawbacks on government benefits, and it's cash flow, not income, so it's taxed lower. So it's all these benefits for self-made dividends. Ordinary dividends have 0. So remember, self-made dividends beat ordinary dividends in every way. Now, the principle is investing in your country is not safer. So a lot of people feel somehow if I know the company, I'm going to invest and buy companies that I know that are in my company, and that makes it safer because I know them. But it's not really true. Like every country in the world investors have this home country bias. They tend to buy in their own country, and it's a mistake all over the world. Like it's a huge world. Why are you investing here? About 10 years ago, there was a major financial crisis in Iceland, and I found that Iceland investors had 80% of their money in Iceland stocks. And my first thought was, I can't even name an Iceland stock. So what are they buying out there? Of course, it's basically the same as Canada, right? It's basically banks and oil companies. Now, that's one thing is the home country bias is a big limiting factor, and you're much better off just investing all over the world. And it makes a huge difference. So I'll give you an example. So if you invested 1,000 in 1950 and left it just in the index itself up until end of 2022, in Canada's index, it's averaged 9% a year. Year 1,000 would have grown to 540,000. But in the US, the S&P 500, it's averaged 11.3. So over 72 years, 1,000 would have grown to 2.46 million, like 5 times as much money. That's the US. And, globally, it actually would be a little bit lower than the US. But globally, again, would be way higher than in Canada. So that's when you stick to one just country, and Canada is kind of a low growth country, lower growth than most of the other countries out there. So you should expect lower returns. So it's not necessarily safe for this safe country. For example, if you lived in Buffalo, just across the US border, you wouldn't think that owning the Canadian company is safer than buying a US company. So it's just a brain fart, I guess it is. So here's the other thing is that our Canadian index is, we're only 3% of the global stock market, and it's not diversified at all. Like most of it is materials, financials, and energy. So it's basically rocks, trees, and banks, we call it. Those are like 3/4 of our index. And yet, globally, the index is very diversified. It's all these different sectors. If you look at most of the other sectors in Canada, most of them, there's nothing in here, but 1 or 2%. So bottom line is Canada index is not a diversified portfolio either. Personally, I actually don't think of the Canadian TSX 60 as a core investment. Some investors, not us, but some investors have, a core and explorer. And to me, is our Canadian index should be in the explorer, not on the core. Core would be the global or US, because then, something that's much more diversified and broad. All right, number 8, focus on maximum reliable long-term return, not reasonable returns with less risk. So most advisors will tell you should get reasonable returns with less risk. And again, with, they give you this risk tolerance questionnaire. They say your moderate return, you should get, invest, some growth, some, risk protection, and basically end up not being able to retire comfortably. So real risk is the risk of not achieving your life goal. So as a financial planner, that's how we really look at risk. You set a goal. This is what you want to achieve in your life. So risk is not achieving it. Okay. Now, of course, if you have crappy investments, that's risky. Okay. But it could also be that your investments are so conservative that the returns are so low that you can't make it either. So that's also risk. So risk is not how much up and down your investments go, because if you stay with it and it goes down and comes back, that's not even risk. So risk is you didn't achieve your goal. Now, if it goes down and you panic and sell, then it is risk. So, but if you stay with it, it's not. Okay. Now, for example, if you need 8% a year to achieve your desired lifestyle, so you're investing for 30 years to retirement and you need to average 8% a year. So then you look at your portfolio and think, what are the odds that I'm going to, over 30 years, make less than 8% a year? Now, if you're investing, in an effective equity return, like a stock market portfolio globally or US, it's pretty well always, I might have showed you that before, it's basically always the worst return of the last 25 years has been 8% a year. So it's almost always made more than 8% a year. So your risk is probably not 1, it's probably just 5%, but it's a very low risk that you won't make 8% per year as a long-term rate of return. But if you're in a balanced or bond portfolio, the risk is basically 100%. Like you basically have no chance of getting 8% a year. So this is why I always think of a balanced portfolio or a bond portfolio as much more risky than an equity portfolio, because you're much more likely to fail to reach, to have the life that you want. And just to give you a picture, this is, how I see risk, after inflation. So bonds and cash tend to have not much fluctuation. And this would be more like a cash thing, but it's not, it's getting eaten slowly up by inflation. So you see it's slowly declining, but no fluctuation. While the stock market, has these fluctuations, but it's going up over time. So, most investors would think this is risky and this is not, but this is actually losing money long-term, not short-term, long-term. All right, so nobody can retire comfortably with a balanced portfolio. I've shown this before, but it's something that's really important to understand. So, and this is again why when you go to an advisor and they fill out the risk tolerance questionnaire and you're moderate and they put you in a balanced fund to me is already you're resigning, saying, I give up, I will never make the retirement I want. That's what they're saying. So rather than just, sticking you in this crappy portfolio, it'd be much better if they took some more interest in you and helped you try to develop a long-term, a higher risk tolerance. Maybe you can invest more effectively because it's the only way that you can get to the goal that you want. And I'm going to show you that in just one sec. Now, a balanced portfolio, what that is it's investment. There's kind of 3 main asset classes for investing: stocks, bonds, and cash, right? So stocks, you're investing, or it's also called equities. You're investing in shares of companies. Bonds, you're loaning money to the government or companies, and cash is like a savings account or something like that. Now, having a balanced portfolio, like an asset allocation, reduces volatility short term, but not long term. Okay, remember I showed you that before. And a way to think of, like, a lot of things, when you look at them long term, they all of a sudden become clear, and short term they don't. You're always saying, well, how much does it go up and down, and can I tolerate and stuff? But you know what? If you just think stocks long term should make 8%, let's say, for example, and it's a reasonable expectation. Balanced portfolio 5, bonds 2. And so if how many 8s and 5s and 2s do you want in your portfolio? If you think of it long term, that's just a more effective way to look at it. So I did a talk about this, the death of bonds. So basically the risk of bonds to your retirement. And bonds, I think, like, to me, they're just so risky to your retirement. You really have to be careful with them. They fine for short term if you have something temporary, but for long term investment. But the bottom line is, once you go to the advisor and you fill out your risk tolerance questionnaire, you cannot retire comfortably with a balanced portfolio. And I'll show you an example in a moment. So basically, to retire comfortably, you need the kind of 7 to 8% per year returns of an equity portfolio. And I've done, literally thousands of financial plans for actually people here in Canada. And it's basically almost nobody can make it with a 5% rate of return that you get on a balanced portfolio. But once you get a bit higher return, it's just massive how much difference it makes. Now I'll show you an example. So here's a few examples. I'm going to show you them quickly. But let's say you're, 35, you're going to retire at 65. You're making $50,000 a year. You're single. You want to retire on $40,000 a year in today's dollars. Okay, in 30 years from now. So if you're making 5% a year over your life, you need 1.15 million. You have to invest 17,000 a year. Remember, you want to make 50,000 a year before tax. That's 34% of your income you have to invest. You're never going to do that. But if you invest in an equity portfolio, make 8% a year, you need to get up to 775,000 to retire. So you need much less because your investments are going to get a high return after you retire. You have to invest 6,500 a year. That's 13% of your income. That's not easy, but certainly that's a doable number. This is not. So here's a couple. So they each make 50,000, so 100,000 together. They want to retire on 40,000 each. That's 80,000 together. In 30 years from now. So with a balanced portfolio, they need $3 million. They have to invest 34,000 a year. They only make 100,000 gross before tax. They have to invest 34,000. That's nuts. But if it's 8%, if they invest in equities, they need to get to 1.55 million. Then again, they have to invest 13% of their income. So it's not even maxing your RSPs here. So this is now a higher income. Let's say you're single, you make 100,000. You want to retire on 75,000 a year in today's dollars in the future. You need to get up to 3.375 billion. You have to invest 50,000 a year. So you make 100,000 a year before tax, right? You only bring home like 70,000. You have to invest 50 of it. That's just totally stupid. So you can't possibly make it. So, but with an equity portfolio, 8% a year, you get up to 2.275 million. You have to invest, 19,000 a year. That's basically 20% of your income. That's, not easy, but, something you could do. Now, here's a couple. So it's 100,000 each. They want to retire on 75,000 each. So they make 200,000 together. They want to retire on 150,000, in today's dollars after they retire. Balanced portfolio, they need 6.8 million by the time they retire to do it. They have to invest 100,000 a year. That's one of their entire paychecks before tax. Okay, but with equity investments, they need to get to 4.6 million. That's 40,000 a year. Again, 20% of your income, not 50%. So this is interesting. When you look at a financial plan, you realize this balanced portfolio, there's just no chance. You're just never going to make it. But with an equity portfolio, you've got a decent chance to do it. And it's funny, like most people that call themselves financial planners will stick you into a balanced portfolio, thinking it's, somehow it's safer because they're this way, but they haven't done the retirement plan, and they don't even know often that, that they basically, you've got no chance to have the retirement that you want. And here's an upscale one. So let's say that, you're making 500,000 a year, you're a doctor, you want to retire on 300,000 a year, and again, so it's 30 years from now, a 5% a year return, you need to get up to 18 million to get the whole 300,000 a year, growing by inflation. You have to invest 265,000 a year. That's 53% of your income. So you make 500,000 a year, and if you're at that level, you're probably only going to bring home 300,000. You have to invest 265,000 of it. It's crazy. Now, again, an equity portfolio, you need to get to 12 billion, not 18. You have to invest 103,000, again, 21% of your income. It's, it's not easy, but it's a little bit more than in maxing your CPP and TFSA, or your RSP and TFSA. All right, so I just want to make sure that's, absolutely clear that you understand that. But basically, nobody can retire with a balanced portfolio. You need to have an equity portfolio. And that's the thing that I see so many people that deal on their own, or go through the conventional wisdom, or go to a regular advisor, and they get stuck into these balanced portfolios. There's a crisis of retirement because you need very few Canadians actually saving up enough money to have the retirement that they actually want. What actually happens is they save up an amount, they retire, and they just kind of adjust their lifestyle down. And you see a lot of people, after they retire, they have to cut back their lifestyle a lot from where they were before. All right. And a related one is you need investments and growth after you retire. Again, so I've seen thousands of retirement plans. And here's what you might be shocked with. In most retirement plans, saving up for, to retire at a reasonable income. So somewhere between 70 and 88% of the retirement income, let's say, you retired for 30 years from 65 to 95, between 70 and 80% of that retirement income is growth after you retire. So you've saved up, like for example, in this case, you've saved up 12 million bucks and you think that's what you're living on. But almost all the money that you're living off of is actually all growth after you retire. That's why you still need, you still need to stay invested. The big mistake I see a lot of older people do is once they retire, they think, oh, I'm retired, I'm older, I need to invest much more conservatively. They get a lower rate of return. And instead of getting 8, they're getting 5. And now all of a sudden they are nowhere close to the lifestyle that they want. Once you have confidence in equities as a long-term investment and you learn to have a higher risk tolerance, you can have the future that you want. You can save up for it and live effectively. And, you tolerate these ups and downs, but that's the route to have the life that you want. All right, here's the next one. Real estate needs a large mortgage to be a good investment. And this applies partly to your house, more so to rental properties, but I just want to give you kind of a sense of it. So first of all, a lot of people think that real estate has a return similar to the stock market, but it's actually not. So this is Toronto real estate, Toronto stock market. Right. So from 1975 till now, Toronto real estate, the average house in Toronto in 1975 was 75,000. Now it's a little over $1 million. So that's what it's done. But if you were in the stock market, Canada stock market, you had over 4 million, globally 7 million, and US almost 10 million. So you'd have, 5-6 times as much by investing in the stock market versus real estate. So real estate growth is a lot lower than stock market growth over time. Okay, I'll start with that as a basic principle. And people think that, real estate is a lot safer than stocks. It looks that way because you can see your house and it looks safe. But, real estate here in Toronto, the biggest drop we've had since 1950 was a drop of 28%. It was down 4 years in a row, like 6 out of 7 years. And then it took 9 years to recover. And then, so the total was 13 years from top to bottom and back up again, 13 years with zero. With stocks, the longest we've had bigger declines. So it's been, 1.5 times as big as the real estate decline, but it was only 2 down years, and it was all the way back up after 6 total instead of 13. So real estate, when it doesn't go down as often, but when it does, it goes down much longer, and it takes much longer to recover. So it's still, like the downside is 2/3 as risky as the stock market. Now, if it's the big difference to why real estate tends to be a good investment, though, is because you leverage it. And a lot of people don't borrow to invest in stocks, but they do for their real estate. So it's normally called a mortgage, right? You get a mortgage on your home, and it's because, you put 20% down on your own home. So you buy $1 million home, you've only got 200,000 in, the property grows a bit in value. It grows, 4%. But because you only 4% on $1 million, it grows by 40,000, but you've only got 200,000 in. So you actually made 20% on your money. So it's the leverage effect that makes real estate a good investment. And without it, like if you have your home or a rental property with no mortgage, it's a pretty low return investment. Long-term average has been about 4% a year. It's a bit more than GICs. If it's a rental property, it's all taxable. So it's kind of, think of it a bit like a GIC. But here's the example that I get, and this will kind of paint it. So I have people that will say, I have 250,000. So what I'm thinking is, should I put this 250,000 in the stock market, or should I put it down on $1 million property? Well, what's going to do better? Well, so what you're comparing is $1 million in real estate to 200 in a rental property, 250,000 in the stock market. Well, probably the property will do it's just 4 times as much, right? Now, however, you can get a 3-for-1 investment loan, which is basically like getting a 75% mortgage on a home, on a rental property, right? So you put down a quarter and the other 3/4 comes from the bank. So then it would be, you put down 250,000 compared to, on a $1 million rental property, or you do a 3-for-1, you pay for 250,000, you do a 3-for-1 loan to get to 750,000. So now you have $1 million total in the stock market versus $1 million in your rental property. What's going to do better? Overall, the stock market, again, have probably long-term 5 or 6 times the growth or, return. So with real estate, the main factor by far of whether it's a good investment is having a big mortgage. And it's kind of funny because most people with real estate are trying to pay the mortgage off. But as you pay the mortgage off, it gets to be a worse and worse investment. So with rental properties, I have my own rule of thumb is when the mortgage is down to half the value of the property, you're better off selling it because you can invest it in the stock market for higher returns, lower tax, and no work. So that's kind of by a general rule of thumb. Even with your own home, it's nice to retire without a mortgage, but generally it's not really that smart to pay off your mortgage well before you retire, because you get used to spending the money. You don't have a mortgage, you're used to spending that for a little bit. You may well not be able to maintain that after you retire. So generally with your own home, try to pay it off just by the time you retire. It's part of the plan usually. For rental properties, try to always keep it leveraged. You can you could do the Smith maneuver on it or the cash dam and always keep it leveraged up. And that's really how you make them a good investment. And the Smith maneuver strategies, some people think you can't do them on rental properties. That's so you're borrowing against your home to invest. A lot of people do it as part of the retirement plan. They do it on their own home, and it adds a lot of investment that doesn't use your cash flow, and it converts your mortgage into a tax deductible credit line over time. People think, oh, wow, my rental property mortgage is already deductible, so I can't do Smith maneuver. That's wrong, because it's not the mortgage that's deductible. It's the credit line that you build up as the mortgage is paid down. So Smith maneuver actually works really well on a rental property, because it's a method to always stay with 75% borrowed against it. So you have always highly leveraged on it, so that tends to make the rental properties an effective investment. Okay, so number 12, borrowing to invest is the secret to building major wealth. It's borrowing to invest is called leverage. If you think of like a lever, I have this long stick with a fulcrum on something, and trying to lift something else. I can lift much higher if I have much more weight if I have a lever, and that's basically what borrowing to invest is. You're basically borrowing with other people's money, and usually you're borrowing at a more modest rate, like you borrow at 5% and it's tax deductible, and you can invest it and make 8% or more, and with low tax. And you do that for many years. This is a major way to build wealth. And if you look at the really wealthy people in the world, almost all of them made it by borrowing to invest in some way. That's really the secret behind building major wealth. Now, it is risky, so it's not for everybody, but the risk is much lower long term. Okay, so because if whatever you've borrowed, you have to pay the investments even if it goes down. So generally, like any risk borrowing to invest strategy, I always recommend commit to being in at least 20 years. Because then you have a really high chance of having a great result on it. If some people say, I'm going to try it for a year or two and see how it goes. Well, I thought, well, don't even start with that attitude, because I don't know what's going to happen in a year or two. And if you sell when it's down, then you're going to lose money. And it's not a good strategy for you. But if you're going to commit to being in for 20 or more years, it's almost for sure you're going to be way up at that point. So I have a bunch of articles and posts on my sites about the Smith maneuver. It's a really excellent strategy. It's kind of a quirky sounding name, but it's amazing how well it works in a retirement plan. Like, we've had a lot of people that are trying to save up and they're way short of their retirement goal. But once you add Smith maneuver into it, that makes up the difference. It's an extra amount that's being invested for their retirement without using their cash flow. It's really a cool strategy. There's a strategy called life cycle investing. So these are all methods of borrowing to invest. This is kind of the ultimate strategy for millennials. I have a post about that. Also, the Rempel maximum is kind of the maximum wealth building strategy. So there are various ways to do it. All right, number 13, the big risk to your retirement is inflation, not a stock market crash. And that's actually a big surprise, because I find a lot of people when they retire say, I have to be more conservative because I have this risk. What if the market crashes right after retire, right? And I tell you, I've been through that. We've had clients that happened to. So we had clients that had a retirement plan. They saved up the amount they need for retirement, and they retired. So everything was good, and they had the amount of money that they needed. Unfortunately, it was 2008. So 6 months after they retired, their investments were down 40%. So that's kind of the worst case scenario. It's like, oh my God, they're way down. So, but what did we do? We just kept sending them the income that was in their plan and just left everything invested. In a couple of cases, we had to reduce it by $100 or $200 or $300 a month for a little while. But, in about 2-3 years, whatever it is, they were all the way back up again, and they recovered. So this was like the worst case. That was the worst decline, in the last 40 years. That one in the 70s was the worst one in the last 80 years. And yet it was fine to have a big crash. So a stock market crash is actually, if you just stay invested, is actually a very low risk for your retirement. The big risk is inflation. So I've done a bunch of studies, which are on my blog, about the 4% rule. So the 4% rule kind of says that a reasonable, sustainable amount you can take out of a portfolio, say me investing in equities in the stock market, is 4% a year. And I tested it. So over the last 150 years. So let's say that you had $1 million and you take out 40,000 a year, that's 4% of it. And then you increase that 40,000 every year by inflation. And does it last at least 30 years? And I looked at, the last 150 years, like what if you retired in 1871? Well, you've lasted 30 years. And I looked every year. And what happened over those 150 years, there were 5 times that 100% equity stock return failed. So 96%, 97%, it succeeded, and 5 times out of 150 it failed. And once it was a market crash, only 1929. If you retired 1928 or 1930, you're fine. But 1929 was the one problem with a huge crash. And back then, the government banks, the Fed in the States didn't know how to run the country properly and made it much worse. So I don't really think that size of crash would happen now. It was an 80% crash. However, for the other times that it failed was always because of inflation. So the times that it failed was you retired in the late 60s and you retired for 30 years, which means they actually ran out of money in the late 90s in the middle of the tech bubble. Is when people ran out of money, and it was because of inflation. All right. So it's a high inflation. And what happened was we had, they retired in the 60s, the 70s and 80s, we had quite high inflation for 20 years. And so the income that you're taking out, you retired in the late 60s, you jack it up by inflation for 20 years, and now you're taking a huge amount out, and it's just not sustainable. So here's the actual picture. So these are all the years. So remember, you retired in 1971. That's what would have happened with your money, right? So you see there's one case here where if you retired in 1929, you ran out of money. And then here, there's the 4 down here where you retired in the late 60s and you ran out of money in the late 90s. Almost always you end up with, 2, 3, 4, 5 million. If you start with $1 million, you end up with way more after 30 years, which usually means you can, take more later on. However, the big risk here is inflation. And that's why, we have some inflation here in Canada now. And I'm always of the view, like the Bank of Canada is trying to get it down to 2%. And some people say, well, we're down to, 3 now. So isn't that close enough? And the answer is no, it's not, because inflation is the thing. So I'm completely behind what the Bank of Canada is doing. They should keep interest rates as high and as long as possible and get inflation all the way down to 2.0. And so it's staying there. Basically, we had that inflation that low from the early 90s up until 2021, right? So we had really low inflation all that time, and we had it under control. Now we've lost control. We got to get it back. And inflation is the big risk to your retirement. It's not a market crash. So that's why fighting inflation right now is the main factor. We got to fight it, even if rates stay high and for a very long time. All right, so now a growth mindset is how to make smart decisions, not a fear-based mindset. So, I find a lot of people that tend to think, I got to make smart decisions with my money. So there I'm going to do things that protect because I don't want to lose money. And they think that's the smart thing to do. But when you're making financial decisions, usually it's, a growth mindset. If you think over the long term about the growth that you can get and how it affect that, that's how you make the smart decisions. So again, maybe remember, for example, this was one example, this is why you'd choose an equity portfolio over a balanced portfolio. It's a smart decision to do that, even though, it's more volatility, it seems more risky short term, but it is how you make a smart decision. All right. So, and that's just one example, but in general, it's, most things, like people often, I find they'll take a 5-year fixed mortgage to reduce risk, or they'll get insurance, and all kinds of things people do to reduce their perception of risk. And a lot of the cases, it's really a lot of wasted money, and it's a lot of lost money. And if you focus on the long-term growth instead, it's that growth mindset. That's where you make the smart decisions. And that's where you get to live the life that you want. And the last one, optimism is realism. So I think a lot of people tend to think, people that are optimists are pie in the sky, and, it's the pessimists that are realistic about things. And the truth is, that's actually not true at all. So I just came back from Winnipeg, and actually, so it's our group of people. My ancestors were German people. That 300 years ago they were in Germany, then they were in Prussia, which is where Poland is now. And then they spent 100 years in Ukraine, and it's exactly 100 years ago they left Ukraine and came to Canada. And again, why did they do that? In 1923, they left Ukraine to come to Canada. Why? Because the Russians were attacking Ukraine. Does that sound familiar? So there's a war right now, Russia attacking Ukraine. This is the fourth time Russia has attacked Ukraine in the last 150 years. Keeps happening. So, but the interesting thing is, so we just had a big celebration, and people say it's exactly 100 years that we've been here in Canada. But the interesting thing is, we looked at the lifestyle that people had 100 years ago, and it's just nothing like it was today. Like, first of all, healthcare was much lower. They had all kinds of diseases. Like most people seem to die of tuberculosis and typhus and like all kinds of things, the diseases that aren't an issue now. They just had way less money. People had to work hard. They didn't have all the new technology that we have now. They didn't have electricity. Like so life 100 years ago, like if you compare lives now to 100 years ago, our lives are dramatically better in every important way. And you know what? You can see that this is all going to continue. I think a lot of people are pessimistic. Oh, now it's going to go down and now things are going to be bad. But 100 years from now, the lives of people living then will be dramatically better than today in every way. And I'm sure that's what's going to happen. You can just see the trend when you're realistic about it. And as for people who think that now things are going to go bad, here, I just love this quote. It's, on what principle is it that with nothing but improvement behind us, we are to expect nothing but deterioration before us? And the truth is that at every point in the last 100 years, most people were predicting that things were going to go bad from that point on, and they were always wrong. And people predicting that now are going to be wrong again. And it's also optimism is, I'm saying this because it's such an important part of, you need to be optimistic to invest for growth, to save for the future, to have the retirement that you want. Like optimism is it's just a really big part of it. It's really hard to be a pessimist and save up the large amount of money and have the future that you want. So now global wealth GDP is like GDP, and lifestyles have been growing steady. So the general prediction is they're going to be 3 to 4 to 4.5 times higher than they are today by 2100. So people are going to be much richer. It looks like most of the poor countries that are, in Africa and Asia and stuff like that, the poorer countries where people living on a low amount of money are mostly coming out of it. But maybe in the next 50, 100 years, most of them will be middle class like we are. And that will be just so much better for humans. And, there's always, of course, we always seen the new technology, electricity, computers, internet, smartphones. Talking to my dad, he actually said in his life, the biggest new technology was in the 40s when they got electricity. Up till then, they used oil lamps and, like you didn't have light at night. But, we've seen all these new technologies. And, over the next few decades, there's going to be more and more of them. They're coming faster now. And a lot of them, these things have actually all really improved our lives a lot. And it's also related, the stock market. Like stock market are companies that invest in all these technologies and everything else. And again, the stock market is quite a reliable provider of wealth over the long term. I showed you how it was from 1950 to 72 to 22. Like if you invested for 73 years, 1,000 becomes 2.5 million. Like it's amazing how much things grow over the long term. The stock market is quite a reliable thing as a long-term investment. So when you have this optimism, you can make smart decisions and you can be wealthy and you can have the future that you want. All right. So I'm just saying this because, I want you to succeed. So having this optimism, like being pessimistic, is just going to be such a downer as far as it's going to make it way harder for you to have the life that you want. All right. So thanks a lot for listening. So these are, again, the 15 topics, the 15 principles that most people get wrong, right? So everybody needs a financial plan. You got to understand your values, what's important money to you. Risk tolerance is a learned skill. Stocks are more reliable than bonds or fixed income long-term. Dividend investors usually pay more tax, surprisingly. Self-made dividends beat ordinary dividends in every way. Investing in your own country is not safer. So it's not safer. You should focus on maximum reliable long-term returns, not on reasonable returns with less risk. Nobody can retire comfortably with a balanced portfolio. You need investment growth after you retire to retire comfortably. So you need to keep investing for growth. Real estate needs a large mortgage to be a good investment. Borrowing to invest is the secret to building major wealth. The big risk to your retirement is inflation, not a market crash. Growth mindset is how we make smart decisions, not a fear-based mindset. And optimism is realism. Okay, so thanks a lot for listening. So my name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. It's at edrempel.com. You get a free consultation if you're interested in talking about potentially working with us. Just Google or edrempel.com/talk, or you can find that on my blog. Just fill out a form asking for a 30-minute consultation. Just say a bit about what you're looking for. But also, please subscribe to my blog, podcast, and YouTube. If you do that, all that will happen is you will get my post sent to you by email each week so that you can, listen to or watch the ones that you want. So my podcast is at edrempel.com/listen. The YouTube is at edrempel.com/watch. So, all right. So thank you again for listening, and we'll see you next week.